Assalamualaikum and hi everyone. Welcome to Mfrs 102 Inventories. And this is the topic 4 for FAR210. However, for those who are interested in learning Mfrs 102 Inventories, this discussion and also the session that I will be handling in the next few more videos will be also helping you towards understanding MFRS 102, which is on inventories. So let's look at what do we have to achieve at the end of the topic, which is the learning outcome. So you should be able to define inventories in accordance with MFRS 102 inventories. Also looking at the recognition of inventories, determining the initial cost of the inventories, which is going to be dealt in terms of what are the purchase costs, conversion costs, and also those costs that are directly attributable to the inventories. We'll be looking also at the evaluation of inventories, what are the methods and the effect on income, and also the inventory valuations, what are inventory systems, basis for valuation. At the end of the last few videos, you'll be looking at the explanation and how do we calculate the writing down of inventories to the net realizable value for both finished goods and also raw materials. We're looking also at the NRV or the net realizable value test basis using the item by item as well as group of similar items basis. Also looking at when does the inventories need to be recognized as an expense, as well as looking at the disclosure requirement, as well as some illustrative disclosure requirements under MFRS 102 on inventories. So let's start. The objectives of MFRS 102 inventories, they are actually trying to provide guidance of what? Guidance of how do we determine the cost of inventories. The cost of inventories initially and also subsequently, how do we recognize some of the costs as an expense, including some write down of those inventories to the net realizable value. So this MFRS is actually dealing with the application aspects of MFRS 102 to the inventories. It also provides some guidance on the cost formulas that are being used to assign costs to the inventories. So that is the objectives of MFRS 102. So MFRS 102, which is also equivalent to IAS 2 inventories at the international standards, applies to all inventories except work in progress that arise under the construction contract, because this is not related to inventories, but those are related to revenue, which is under MFRS 15, revenue from the contract with the customers. Financial instruments, these are not within the discussion of the standards, which is actually dealt with under MFRS 132 and MFRS 9. We also will not be looking at biological asset that relates to agricultural activities and agricultural produce at the point of harvest. However, the agricultural produce after the point of harvest, which is the harvested agricultural produce, is within the MFRS 102. The MFRS 102 principles of measurement also do not apply to the inventories held by the producers of agricultural and forest product, agricultural produce after a harvest, and also minerals product, to the extent that they are measured at the net realizable value in accordance with the well-established practice in those industries. So these will not apply the MFRS 102 measurement principles. The commodity brokers, traders who measure the inventories at the fair value less cost to sell. So MFRS 102 inventory also will not apply to the commodity or the which relates to broker traders. Okay, let's look at the next one. Why is information on inventory useful to the users? Why do we need to provide information on inventory? The information on inventory will assist the existing and potential investors, lender, and other creditors. So if you can recall, these are actually in the conceptual framework, the users of the financial information. So what we're going to look at is how do the information on inventory assess them, these users, investors, lenders, other creditors, in the management of the inventory. How do they assess the management of the inventory of a particular reporting entity, whether there is a shortage of inventory that will affect the sale and reputation. Maybe too many inventories will be costly. Too many inventories is not a good management of inventories, as that will incur higher storage costs and also will lead to risk of being wasted, where you will come across rotted items or expired goods. So these are the case that should be considered by the management of inventories. Next is also to be able to assess the ability to get inventory at the lower cost, and also, if possible, sell it at the highest price. This is said to be the key to the successful and profitable operation. So that is how we assess the management of inventories through the information provided by the inventories of the reporting entity, as well as evaluating the entity's ability to generate cash inflow from the sale of inventories. Normally, slow-moving inventories will generate lesser revenues and higher costs, and a high turnover or a fast-moving inventories will normally indicate that the products can be sold quickly. When we look at the types of inventories, as you can see, most of us are aware that inventories often represent a significant portion of the total assets of many entities, particularly trading entities. These are the business entities, trading entities, as well as the manufacturing entities. So they consist of items which are held in the ordinary course of business. So therefore, the inventory can either be for trading purposes, or that can also be consumed or used in a production in a manufacturing entity, for example. So for the trading entities, normally the case is where you acquire goods for the purpose of resale. Let's say you are dealing with a property business. So you may buy the house for the purpose of reselling it. So the inventories are the house that you bought, and that should be in the normal course of business. The finished goods, the completed products, that should be under the manufacturing entity. So these are some types of inventories under manufacturing entities: finished goods, work in progress, and raw materials. So we will go into detail all this later. But the point is, for manufacturing entities, it consists of the finished goods. The inventories will also consist of work in progress and raw materials, the component of inventories. Let's look at the definition of inventories as per Mfrs 102 inventories itself. Inventories are assets and assets that are held for sale in the ordinary course of business. It is not in an occasional sale, but you are selling, let's say, the houses or the properties in your normal day-to-day business activities, which is your ordinary course of business, not occasional business. In the process of production of for such sale, and also in the form of material or supplies to be consumed in the production process or in the rendering of services. So number 2 and number 3 is related mostly to the manufacturing entities, and for item 1 it is normally related to the trading entities, like what we earlier has been informed here. Let's look at what are the examples of number 1. For example, the one held for sale could either be goods that you purchase and you later have the intention to sell it in your ordinary course of business. Let's say dealing with cars. You purchase cars and you are selling the cars in your normal business activities. Or it can also be finished goods. Goods that you purchase for held for resale, as well as any finished goods that perhaps in a grocery business, for example. And then process of production. in the process of production, for example, work in progress, not yet completed, but in the process of being completed, or perhaps the finished goods that are being produced in the process of the production. Material or supplies relating to the raw materials that are to be consumed in the production process, and also some other consumable items that are awaiting for use or in the production process or in the rendering of services. Let's look at the first example here. So the situation is to check whether or not the asset meet the definition of inventories. This is on classification. So identification is when you identify whether or not there is an asset. But when we talk about classification, is about whether or not that asset that you earlier identified meet the definition of the particular standards that we are dealing with. And now we are dealing with Mfrs 102 inventories. And recall the definition that we earlier have discussed. So example 1 is about Joran Kyle Berhad, which is a wholesale company. And Joran Kyle involved in buying and selling fishing boats. That is the ordinary cost of business of Joran Kyle. So the question is, with reference to Mfrs 102 inventories, identify whether the fishing boats are items of inventories. So we need to go and identify, and also when you need to identify, you need to also look at whether or not the fishing boats meet the definition of inventories. So the issue is, does the asset, fishing boat, meet the definition of inventories? So if you look, yes, the fishing boats are items of inventories. Earlier, you were informed that the business is dealing with buying and selling of fishing boats. So the fishing boats are asset and they are held to be sold in that ordinary course of business, which is dealing with a company that involved in buying and selling of fishing boats. So that is answering the first part of the question, which is the inventories here is in the case held for sale in the ordinary course of business. Next is looking at the measurement of inventories, or the initial cost of inventories, and we are using this under the cost model. And initial measurement of inventories, it shall be measured at cost. So let us look at what are the component of cost, which is the initial costs. So the initial cost of inventories comprise of cost of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. For details, you can refer the pages that I put here, which is from our textbook, the Financial Accounting and Reporting by Tan Leong Tong, the 7th edition. You can refer this details here. And let's look at the measurement of inventories, looking at how do we look at the initial cost for inventories that are being purchased. Normally, this is for trading inventories. So the cost of purchase, according to Mfrs 102, will comprise of the invoice price, or the list price of the inventories, or the purchase price of the inventories, plus all directly attributable costs of purchase, just such as the import duties, other taxes. The other taxes here refers to other than those taxes that are subsequently recoverable from taxing authorities. As in the case of Malaysia, this is recoverable from the Inland Revenue Board. But we are not looking at that, but we are looking at the non-refundable tax. Transportation costs and also handling costs, together with some freight insurance. That also needs to be considered by deducting the trade discount, rebates, or other similar trade allowances. So basically, there are three major elements of cost of purchase. So the cutoff point to capitalize or to include that as part of the cost of the inventories, is up to where the inventories have reached their intended location and also the condition. So location here, for example, when a shipment of a raw materials that were being delivered, let's say using a delivery truck, have reached the warehouse or the address or the point of sale that is required by the buyer, reach the inventories. Condition, for example, the inventories are now ready for use in production if that is in the case of inventories to be used in the production process. Let's look at the measurement of inventories for the manufacturing business or the cost of manufactured inventories. For details, you can refer page 2408 of the textbook and read the note on 7.2.2. Cost of purchase will normally comprise of raw materials or any direct material. It will also include cost of conversion because these raw materials or direct material will have to be converted into finished good during the manufacturing process. So this will include the cost of conversion such as fixed and variable manufacturing overhead. Finished goods shall also include conversion costs of direct labor, production overhead as well. And MFRS 102 inventories requires the application of the full absorption costing principles to the inventories. So let's look at the next part of the cost of conversion as laid down by MFRS 102 inventories. The MFRS 102 inventories requires a systematic allocation of variable and fixed production overhead. The variable and fixed production overhead that are incurred in converting those raw materials or direct materials into finished goods. So the variable production overhead costs are those like indirect materials and indirect labor. That will vary directly or nearly directly with the volume of production. So these were actually those that you may have learned from the costing courses. Fixed production overheads such as depreciation and maintenance of inventories, factory buildings, and equipment that were used in the factory management remains relatively constant regardless the volume of production. So the standard specifies that the allocation shall be based on the normal capacity of the production facilities. So therefore, these are the costs of conversion that may have to be actually allocated accordingly based on the normal capacity of the production facilities. So we have also some other costs that are also part of the cost of inventories, which are related to whatever to be included in the cost of inventories are those that are to the extent being incurred in bringing the inventories to the present location and condition. Right. What are these costs? What are the example of the costs? For example, you may have item like cost of designing product for specific customers, tailor-made for them, borrowing costs incurred to bring the inventories to their condition for sale, borrowing costs for development of a machine, for example, and that was other costs incurred to bring the asset to its present location and condition. And however, there are some costs, that shouldn't be included as part of the cost of inventories. So these are the costs that should not be included. So when you say that it is not included, it simply means that if you have incurred those costs should have been recognized as expense. So it shouldn't be added as part of the cost of the inventories, but should be recognized as an expense in the statement of profit or loss in the period to which they are incurred. What are those examples? Costs that relate generally to the purchase, such as salaries of purchasing officers in the admin department. All selling costs, all selling and distribution costs, even though the standards does not mention the word distribution cost, but somehow all selling costs also may include selling and distribution costs, which are incurred by the seller to complete a sale transaction. But this one shouldn't be included in the cost of inventories, and this will be expense of in the year or in the period in which it is incurred. So these are necessary to make the goods available to the buyer from the point of sale to the point at which the buyer takes possession. So this is more towards the buyer. So we are not looking at the point of view of the buyer, we are looking at the point of view of the reporting entity. So abnormal amounts of wasted material also shouldn't be included. So if there are any abnormal amounts of wasted material, labor, or other production costs, that shall be recognized as an expense. Storage costs. So you have a storeroom, for example, used to occupy the inventories that you have produced, right? And if this is the storage cost after the production process, this storage cost is to be expense of. However, if that is necessary in the production process before a further production stage, that can be included. If that is after the production stage or the production has been completed, that is not to be included as part of the cost of inventories. Admin overhead that do not contribute to the bringing of inventories to the present location and condition. Exchange difference, loss or exchange difference in the form of gain, foreign exchange, that arise directly on the acquisition of inventories that are using the foreign currency. Either you import the goods overseas, or maybe you use the foreign currencies even though you are buying goods in Malaysian in a local environment. So as long as you use the foreign currency, you are normally exposed to the fluctuation, and that fluctuation will cause exchange differences, either loss or a gain. So this loss on exchange difference shouldn't be included in the cost of inventory. Okay, we'll stop there, and we're going to continue with how to calculate the cost of inventory in my next video. Till then, I'll see you when I will see you, and until then, have a nice day ahead.